Hi, welcome to ArkIntel. Imagine that you are on a plane. The pilot announces some turbulence ahead but reassures you, "Don't worry, we are heading for a smooth landing." You sit back, trying to relax, but you can't shake that uneasy feeling. That's exactly where Wall Street is right now. The Federal Reserve is raising interest rates, the economy is slowing down, and yet everyone's whispering about a soft landing. It's a comforting term, but is it realistic? Let's rewind the clock a bit. In 2007, just before the financial crash, the same term was being thrown around, soft landing. Ben Bernanke, then the Federal Reserve Chairman, the International Monetary Fund, and experts across the board promised we would avoid a crisis. We all know how that story ends. But here's the twist. It's happening again. So, what exactly is a soft landing? In simple terms, it's when the Federal Reserve raises interest rates to slow inflation, but pulls back just in time to stop the economy from crashing. The idea is to balance on a tightrope, cooling down the economy without causing a recession. Sounds perfect, right? But here's the problem. It's like trying to pull off a flawless dive into a shallow pool. One wrong move and splash, disaster. Now let's look at the data. Over the past 50 years, the Federal Reserve has tried this 11 times. Only 3 of those attempts, yes, just 3, resulted in a true soft landing. The rest, they led straight into recession. In 1967, 1984, and 1995, the Fed managed to pull off these rare soft landings, raising rates without derailing the economy. But that leaves us with 3 successes out of 11 tries. The odds? Not great. Yet, here we are in 2024, and analysts are once again predicting we will avoid the worst. But why? Just last month, new data from the US job market showed some impressive numbers. The unemployment rate dipped to 4.1%, and the economy added a staggering 254,000 jobs in September. There are now 159 million people employed, more than ever before in the US history. That's why Wall Street is buzzing. But before we celebrate, let's take a step back. This all feels a little too familiar, doesn't it? Let's jump back to October 2007. The job market was booming, stocks hit all-time highs, and everything looked perfect. Until it wasn't. Just months later, the economy spiraled into the Great Recession. What looked like strength was, in fact, the calm before the storm. So when experts today point to a strong job numbers as proof that we are safe, we need to remember, the economy is like the weather. What's sunny today can turn into a storm tomorrow. Now, here's where things get really interesting. If you want to know where the economy is headed, don't focus on jobs or the stock market. Focus on credit. Think of credit as the lifeblood of the economy. When banks are willing to lend, businesses can borrow money, hire more workers, and grow. But when banks start tightening up, when it becomes harder to get loans, the economy starts to slow down. And historically, that's when recessions happen. Right now, credit conditions are tightening significantly since mid of 2023. And every time we've seen this kind of tightening in the past, it's been a warning sign of a recession just around the corner. So, if credit is tightening, why hasn't the economy crashed yet? Here's the twist. Credit hasn't always been this tight in past soft landings. For example, in 1995, when the Fed pulled off a soft landing, credit stayed loose. The economy kept moving because money was still easily available to borrow and invest. But today, we are seeing the opposite. Banks are closing their wallets and credit is becoming harder to get. And that could be the red flag we are all missing. So, how does the story end? Let's compare credit conditions with the unemployment rate. There is a strong connection between the two. When credit tightens, unemployment usually follows, but with a delay. We are seeing that delay now. Unemployment hasn't spiked yet. But if history holds true, we could see the job market start to weaken by mid-2025, unless credit loosens again, and that's a big if. So, are we really headed for a smooth landing, or are we flying straight into the next economic storm? Only time will tell, but here's the bottom line. The odds aren't in our favor. We've seen this story play out before, and unless something drastic changes, we could be in for a rough ride. If you want to keep up with the latest economic trends and see how this unfolds, hit that subscribe button now. Here at ArkIntel, we'll be following this every step of the way.